We are going to talk about an exciting topic today, and it's year-end tax planning. Our year-end tax planning and usually our market update are our two most attended workshops that we give, webinars that we give. So I'm glad that you've all tuned in for our topic today. We have lots to cover, as most of you know. Once we get into some of these topics, it's like drinking through a fire hose. For those of you who've been coming to these year-end tax planning meetings for a while, you're definitely going to see some of those strategies reappear, because we think that a lot of the fundamentals around tax planning don't really change. You just got to refresh them and get them up to date. So I hope you enjoy this. A couple just housekeeping items. I'm going to try to do some Q&A. This is going to be broken down into two sections. The first half of this is going to be primarily focused on personal tax planning, meaning how it impacts your personal tax return. And then we're going to have another section if you're a business owner, which really would apply to people who are S corporations, LLCs, even sole proprietors potentially. So that's kind of part two. So that might be a good time to fall off. There's going to be a clear delineation on when we're going into business planning. So the other thing is please ask questions as you're going through this. Because the personal section is probably going to be about 35 minutes, and then the business will be about 25 minutes. We'll go about an hour. So I'm going to do my best to get to questions. If I can't answer them on this webinar, our team will get back to you in the next few days. And just additionally, if you have to drop off, this will be recorded. We will be sending this back out. We do intend to share this through like Facebook and other social media, just to kind of share the message, because we think this is really now the perfect timing to start planning. The corporate tax deadline was September 15th, and the personal tax deadline for last year was October 15th. So hopefully most of you filed your taxes, because it does make it easier to start planning for this current year once your previous year was done. Okay, just a couple disclosures here for Vance Wealth. I'm not going to read those. All right, so first thing we want to talk about, and this is really actually going to be a quick conversation. So we've been getting this question: what impact will the Inflation Reduction Act of 2022 have on my personal income taxes? So this was the new bill that was passed that just made it through Congress and signed by the president. So I just wanted to give you an update on that. There's essentially going to be no changes to individual income taxes. Now, I know it's kind of hard to believe, right? Because this was a pretty big bill, had a lot of I wouldn't even say tax policy. It was a lot of spending policy. So essentially no changes to individual income tax. There were some, and this is according to the Tax Foundation, there were some items that are going to impact corporate and international taxes. So, one of the things that I think Washington has been keen on is this feeling that a lot of the big companies aren't paying their fair share of taxes, whether you agree with that or not. That's the reality. And you can see this first bullet point. It says imposing a 15% minimum tax on corporate book income for corporations with profits over 1 billion. So obviously looking at these big companies that are making profits over $1 billion to impose this higher corporate income tax. And then the bottom one, which might have some impact on stock prices, is fairly minimal because the tax is pretty low. There's going to be a 1% excise tax on the value of stock repurchases. So, companies can repurchase their stock instead of paying like a dividend or paying profit out to their shareholders in the form of a dividend. And so there's going to be a 1% tax on that. So not meaningful. It's 1% now. We also know we can get nickeled and dimed to death on tax policy. But these were essentially the big changes or no changes to your individual income taxes. The reality is, though, I think the big thing that hit the headline, outside of a lot of the environmental spending policies and incentives that were put in place in the Inflation Reduction Act, there was a big focus on beefing up the IRS's ability to kind of come after tax cheats, which, at a high level, that's actually not a terrible thing, right? Because we don't want people to cheat on their taxes. We want people to pay their share of taxes based on how the code is written. And clearly, a lot of tax planning that we're going to discuss today deals with how do we make good decisions around the tax code? How do we utilize the tax code to make favorable tax decisions for yourself, for your family, for your business? But clearly, if people aren't paying the tax that they owe, that's a problem, right? So don't know if I really agree with this strategy, but, actually I can tell you, I don't really agree with this strategy, but I do think it's imperative that, we don't have a system full of tax cheats that doesn't help anybody. So you can see what they're talking about doing. This shows the current projections on where the spending is. The blue lines show what the Inflation Reduction Act will do in terms of increasing the amount of money for enforcement, for operation support, for taxpayer services, business systems modernization. You know, they talked about the headline we see is this 87,000 new IRS agents. Frankly, if you're a CPA firm in town, you're having problems finding good talent to actually work as a CPA, in a public accounting firm. Whether you're a small accounting firm or a larger one, they're having enough trouble finding good talent. I feel like the IRS is going to have even harder time. So I think it's a little bit more for headline shock. Frankly, they probably just should have put a lot of this money just into business systems modernization and use things like AI, artificial intelligence, to actually beef up the ability to scan tax returns. So just wanted to make you aware of that. That's definitely going to be something you should all be aware of. And what that basically means is that, especially as a business owner, that when you are taking deductions for business expense, that there has to be business purpose. Documentation for things will be extremely critical. It was always necessary, but obviously with this increase, authority to add more auditors and really try to go after reviewing people's tax returns is going to be critical, that you're really playing within the rules of the tax code. So again, you should always be doing that, but this is something that if you've been stretching things a little bit, you definitely want to be mindful of that. Okay, so let's just kind of jump into, we're going to go through some tax planning tips, and you can see the note, it says for everyone. This really applies for everyone. Obviously has to be applicable based on your situation, but we're going to go through some of the tried and true tax strategies. I'm going to go through them and explain, who they might apply to and how they will impact you. And a lot of what we're looking at is, at the end of the day, when you're talking about tax strategies, there's a few things you can do to actually save taxes. There's a lot of things you can do to kind of defer taxes. And so we're going to talk, we'll get into that with some of these planning strategies. Okay, so we're big proponents here at Vance Wealth is really, when we're doing planning, we're trying to look into the future. We're trying to anticipate what the future might look like. And, there's a few things that make that extremely difficult. Is we don't know what everyone's financial future is going to look like. We don't know what your income is going to be every year. While we might have an idea, we don't know for sure. We don't know the state of the economy, whether we're going to be in a growth economy or a recession. And we don't know what's going to happen with future taxes, right? So if we're basing our decision-making on the future, we're having to make some assumptions. So we have to use a pragmatic approach. We have to use some assumptions. But one of the things, and you can just see some of the narrative we have up on the screen, is like, when we look at financial planning, really the beauty, and especially around tax planning, is to create this roadmap for what does the future look like for me individually based on my goals, and then how do we set up a tax strategy that might be able to maximize our tax savings over time, right? We know we can't for sure do it, but we want to have a strategy in place that can help us do that more effectively, given the data we have today and the data that we think we might know in the future. And, obviously I'm hedging because we don't have a crystal ball, but that's what the attempt is, to not only anticipate the future, but make changes as things change, right? As the tax landscape adjusts, you change strategy. As your income adjusts, you change strategy. So just being flexible, but by having a foundational plan, that's where you can start making some of the best decisions. So we're a big proponent of having this long-term tax philosophy of utilizing the code and making sure that, when rates are low, which I believe they currently are in many tax rates, that you utilize some tax saving strategies that are going to help you today and in the future. So what I have circled here, and there's a lot of colors going on, but let's focus on the right-hand side. So on the left, it's dealing with single filers. On the right, it's dealing with married filers. So I don't want to go through each example. You'll get the gist of it. But in 2017, and this was prior to the Tax Cuts and Jobs Act of 2017. So in 2017, we had, you can see the rates on the far right-hand side, a 10% bracket, a 15% bracket, 25, 28, 33, 35, and 39.6. Those are all the rates. Those are all the marginal rates, right? So as you get into these new brackets, you pay incremental tax at these higher and higher rates. So I've highlighted there, it's kind of an orange color that shows a 25% bracket, a 28% bracket, as well as a 38% bracket. And if you look at the income levels kind of next to it, you can see the brackets in terms of when you get into these income levels, this is how much you're going to pay. Well, I've also highlighted, so that was based on the 2017, that was prior to the changes. Well, now in 2022, this is the current tax code. So people who are making, you can see that 24% tax bracket, which we've highlighted, which is an income range between 178,000 and 340,000, they're going to pay at 28. Well, the reason why we bring this up, the reason why we've been using this chart for the last several years is that without Congress acting and actually changing the tax code, making policy changes, this the Tax Cuts and Jobs Act is set to sunset or expire at the end of 2025, which means without new legislation in 2026, they're going to revert back to these 2017 tax rate or tax brackets. Now they'll adjust the income a little bit, but we're essentially going to revert back, right? So you think of the political landscape we're in right now, 2022, we're going into midterm elections. It looks like we're going to have a split government. Don't know for sure, but it seems to be that way. That means in 2023 and 2024, it's going to be very difficult to make any big tax changes just because of a split government. So that means with the new president coming in, or not a new president, but another election in 2025, we'll have basically a year to make some of these changes. And so we're not sure if that's going to happen. We're kind of doubtful that we're going to see lower taxes forever, because we all know our federal deficit, our budget deficit is north of $30 trillion. So likelihood taxes might go up. I know that's, don't shoot the messenger, but that's kind of what our expectations are. So the reason why this is so significant is we look at a tax year like 2022, and then looking forward, 2023, 2024, and 2025. We have basically a 4-year window where, depending on where your income sits, you might be able to take advantage of what we would deem as artificially lower rates, meaning the 22% bracket and the 24% bracket. And so this starts to shape our advice that we're talking to clients about and coordinating with their accountants, because we feel that, okay, at some of these rates, we might want to make some other alternative decisions about deductions and deferral. We might opt to pay some taxes at these rates. And so we're going to go through some of the scenarios of which you might want to make these changes. So the big one is funding a Roth IRA. So, a Roth IRA basically is an account that you can fund. And when you put the money in there, all your future gains, which would be capital gains, dividends, as long as that money stays inside the account, essentially accumulates tax deferred. And then when you take it out, eventually you will not pay any tax. So all those gains are designed to grow tax-free. Now, there are some restrictions on it. You have to have it in place for 5 years, but essentially for most people, their Roth IRAs are kind of these long-term accounts. You also have the benefit of being able to pass this money on to the next generation, being your children, let's say, and they can take the money out tax-free. So the Roth IRA, when you do compounding of money over a long period of time, it really can save tens and even hundreds of thousands of dollars over your lifetime. And so because the all future withdrawals are tax-free. There's also no required minimum distribution. So we should all know that at age 72, you're required to start taking out of traditional IRAs. Roth IRAs, you can allow that to compound for a long period of time. Now, the one thing here is there are income limitations for Roth IRAs. So if you earn too much money, you're not eligible to fund a Roth IRA contribution. However, if you don't qualify for a Roth IRA contribution, you might be able, you might want to consider a Roth IRA conversion. So even though you can't fund the Roth IRA, you can take money from your traditional IRA and convert it to a Roth IRA. Now, when you do that, that's a tax event. You pay tax now. But the reason you would do that is really twofold. You're looking into the future and saying, okay, how can I limit some of my future tax by paying tax today? The other thing, and this especially is true when we're going through a market like we're dealing with today, is that, the stock market is down, in the neighborhood of 15 to 20%, depending on what index you look at. Additionally, bonds are down quite a bit this year. This is a pretty abnormal thing to have happen, where stocks and bonds are going down kind of in tandem. And you're seeing bonds down, 10%, 12%, 15%, pretty substantial, even on some of these longer term bonds. And so one of the reasons why we like doing Roth conversions when we have down periods in the market is that essentially you're converting shares of an investment that are now at a lower price. And, basically we're counting on that over time, assets will rise. And so you're converting it at a lower price. And so that growth that we get back once the market kind of gets back to some normalcy and maybe back to all-time highs, that you've now recovered the losses in the market that you've experienced this year. And not only have you recovered it, as all those gains are now tax-free. So again, Something to consider. We are happy to run a calculator. We're happy to help run some tax projections to figure out how that fits into your plan. Many of you, we've been having these conversations for years. We do think this is a good year to really be reevaluating that. So one of the things that I want to run into, I'm going to do this pretty fast. This slideshow will be available if you want to get into the weeds, but I'm going to run through the top 10 IRA planning mistakes that we see. This is courtesy of actually MFS. They provided some really good data on here. So I'm going to run through some of these items and apologize if a little bit challenging to see. Let me just move something around here real quick. Okay, so here are the top mistakes. Not naming or updating IRA beneficiaries. And so we all should know that you name a beneficiary, it's likely your spouse, your children, maybe your trust. Making sure you either name the beneficiaries and contingent beneficiaries and updating them. These are things that we like to review about every 3 years. So if you feel like we haven't looked at it in a while, let us know. We'll do a full review of your beneficiaries. This is highly recommended because the unintended consequences of not naming a beneficiary properly can have an impact on issues for the estate and for potentially some tax issues. So that's number one. Number two, not planning for taxes on inherited IRAs, right? So when you inherit an IRA, you're going to have to pay tax on the distributions, and there are requirements that you have to actually follow based on the inherited IRA rules. This is also true then for the next generation, right? Is, you know what, you've been accumulating all this money into IRAs over the years, and the tax liability that's going to be passed down to that next generation could be quite substantial because there's now in place what's called the 10-year rule, which beneficiaries can no longer take the IRA that they inherited over their lifetime. They have to take it out in 10 years. And so it used to be where somebody, if they inherited an account at age 65 and lived to 95, they could take it out over 30 years and spread the taxes. Well, now it's shrunk down to a 10-year window, and that 10-year window is now requiring that you take it out over a period of time. So on larger IRAs, it can create a lot more unintended tax liabilities. Number three, making inappropriate spousal rollovers. And so if you're a husband and wife and one party passes, the spouse has an option. They can either leave it in the deceased spouse's name, and or they can roll it into their own IRA. And you want to do a calculation based on how old they are, RMD expectations, things like that, to make the determination on what's best. This is especially true if you have a spouse that passes at a much younger age, like before age 59 and a half, because there's definitely some advantages of not doing the rollover. So the key here is you want to make sure you make an appropriate spousal rollover decision, and that's something that should be evaluated. All right, number four, not taking advantage of the Roth IRA. I already talked a little bit about that. Roth IRA is a really good potential tool for a lot of clients, especially around like taxability of Social Security, things like that. So you want to consider that. It doesn't mean a Roth IRA is for everybody. It certainly is not, but you want to allow your financial advisor, Vance Wealth, to help you and kind of guide you through that. Number five, not taking advantage of maximum contribution limits. Now, in 2021, you could do $6,000, which is $500 a month. And in 2022, it stayed at $6,000. But if you're over age 50, you can do an additional $1,000 catch-up contribution. So we really just feel that, for those of you who are dedicated to saving, being good investors, like, take advantage of those contribution limits. And I know 6,000 doesn't sound like a lot, but we've run these compounding exercises of showing the benefits of starting young, like in your 20s, and how much that can grow to over a period of time. And so it's really important, if you can, is really be dedicated around, making sure you can maximize those contributions. Number six, assuming that a non-working spouse cannot contribute. I see this a lot of times. You have a husband and wife, one retires or one never really worked. And the truth is, in many cases, they will be eligible for a spousal IRA, even if they have no work history. There are some income limitations based on just how the tax code is written, but just don't make that assumption, and actually do a little bit of a deeper dive to make sure that if you can contribute as a non-working spouse, that you do so, because it allows you to obviously double the contribution between two spouses. All right, this is really small, so I apologize. Number seven is taking the wrong required minimum distribution. So the key here is that by the time you turn age 72, you have to take a required minimum distribution from your account, okay? That's for all non-Roth accounts. You have to take the distribution. If you don't do it right, essentially there's a federal income tax penalty of 50%, not 15, 50, 50. So you want to make sure you plan and take the RMD accordingly. Those are calculations we're running for you as clients, but it's really important to make sure you do that. And there's different rules on if you have IRAs, if you have old 401ks, old other accounts. That's one of the reasons why we love doing consolidation of accounts, just to make things a lot easier for you to manage. So you're not having to pull from all these accounts. You can actually pull from 1 or 2 accounts. Number 8, not considering qualified charitable distributions. So hopefully by now you're aware that if once you reach age 70 and a half, you actually can make donations up to $100,000 from your IRA directly to a qualified charity. And a qualified charity essentially is a 501c3. There are some other exceptions, but the benefit of doing that is you can make a direct donation, which then lowers your adjusted gross income and your modified adjusted gross income. So this is a really powerful tool that we've been using for years, and we want to continue to make this in many cases because it makes a ton of sense. Number 9, paying unnecessary penalties on early, meaning before age 59 and a half, IRA distribution. So a lot of people aren't aware that if you want to take money out in early retirement, so should you have put yourself in a good financial position to be able to retire prior to 59 and a half, you have the ability to take out money under a code called 72T. And by doing so, it allows you to avoid the 10% penalty. There's a bunch of rules on it. We can definitely run illustrations and help you figure that out. But if you have to take it out for whatever reason, there are ways that we can help alleviate some of that unnecessary penalty of 10% under that IRS code. And then the last one, probably the most complicated, saving the best for last. I'm going to do this super high level because you're going to know if this applies for you. Rolling low cost basis company stock into an IRA. So what does that mean? So many of you worked, for decades, let's say at a company. And if you worked at a company that had stock, meaning their company stock in the plan. So if you worked at Disney, as an example, then you've been accumulating this Disney stock for the last 20, 30, 40 years. And when you go to retire, your money's in a 401k plan and you're going to move it out to an IRA. You're going to do a rollover. Well, there are options for you to actually be more strategic about taking the Disney stock directly out of the plan, paying tax on that, basically on taking the money out. There's something called unrealized capital appreciation. And so you take that actually stock out, and then it helps to eliminate some of your ordinary income tax later. So pretty complicated area, but if you find yourself in this where you have a 401k with a lot of company stock that you've been accumulating over the years, specifically low cost basis, which means the stock has gone up a lot in value. Those are the people who, if you're in that situation, and it's not a lot of people, like I think with our business, it's probably less than 2% of the people. But if that does describe you, make sure you're well versed on how to handle that, because that's a big mistake that will cost a lot of money in taxes over time. Okay, so that's kind of a quick run through, and each of these likely will apply to a few of you. So hopefully that was helpful just to learn a little bit more about the mistakes. And again, this is going to be a recorded video. So if there's those of you who have loved ones can benefit from just learning some of these mistakes, please feel free to share this. All right, so now we're going to get into tax saving ideas for the charitably inclined. So most of us donate cash, and I don't mean physical cash, even though there are a lot of people who donate physical cash, but they're writing checks. Maybe these days they're doing debit and credit card transactions, but they're basically exchanging they're exchanging their cash through different ways. It can even be Venmo, and they're donating that to the charities of choice. We think that you really should be considering donating appreciated securities, which means things like stocks, ETFs, mutual funds, real estate, things that have gone up in value, and donate the appreciated securities instead of cash. One of the beauties with liquid investments like stocks, ETFs, and mutual funds is that you can give them in smaller denominations, right? If you own a house and you wanted to donate it, that's way too big of an asset. But a stock, you can give 1 share of something or 10 shares of something. So it's much more effective than cash, like way more effective. And I'm going to show you the illustration here. So on the left-hand side, and I'm assuming a high tax rate. So if you're not in this tax rate, you got to do some different math here, but cash or check, $10,000 gift, you're in the 50% tax rate. That basically means you're in California, the highest tax rate. And then you save 50% in tax savings, which again is $5,000. If we do an appreciated investment, I'm going to give you an example. Let's say you bought something, Disney stock, or even maybe Apple stock's a better example. You paid $2,000 for these shares. They're now worth $10,000. You have an unrealized gain of $8,000. So if gifted instead of sold, you will basically avoid 35% capital gains on that $8,000. Plus, you're going to get 50% income tax deduction, federal and state, on the $10,000 gift, which puts you at about a 78% tax savings. So the larger the gain that you have on the investments, the bigger the tax savings, because you're essentially getting rid of this unrealized gains. And so one of the questions I do get all the time, so I want to deal with this now, is say, well, what if I still want to own this stock, right? I still want to own this position. I don't want to get rid of it. Well, basically what you do is you swap. You say, okay, I'm going to give 10,000 of stock to get rid of this $8,000 gain. And that check that I was going to write, I'm just going to go rebuy stock. And now I have a new cost basis, which means you got rid of the gain, but you can utilize that gain on a or you can utilize, you can get rid of the gain, and be in a position where if you sell that stock later, you now are not going to have to pay a really large tax bill because you got rid of that $8,000 unrealized gain in this example. So just take my word for it. That's really the best way to go if you have the availability to. Usually when we have years like this year where the markets are down, people are holding on a little bit tighter to their stock positions, but you still want to do the evaluation. So one of the things that I do want to get into is to talk about setting up a donor advised fund. I really like these vehicles. For those of you who are committed to donating to charity north of $10,000 a year, so I know that's not everyone, but north of $10,000 a year, these are really good tools. So essentially how this works is you set up an account. And your account, you can name it whatever you want. I think I have one for me. It's just the John Vance Foundation, I believe. And so so basically how a donor advised fund works is you set up an account and then you donate appreciated securities. So you look at your portfolio and you have things that have gained in value, you donate those appreciated securities into the donor advised fund. Now, you only want to give long-term capital gain assets, which means assets you've held for longer than 1 year. So you donate those into this donor advised fund. At the time of the donation, you get the tax deduction. So if I make it this year, I get the tax deduction this year. Now the money is inside this account. The donor advised fund will actually sell the stock, sell the ETF, and then they can leave it in cash or they can diversify it into investments. And then you, as the donor, get to decide, how am I going to give out this money? So you get to decide, okay, I would like to give, I'm going to start this with $20,000. So I get the deduction this year, which saves me taxes. And then I'd like to commit to giving $500 a month to this charity. And I want to give $250 a month to this charity. So you can make a commitment that will give on a more regular basis. So that's why I really like them, because you can give away the appreciated securities, and then you can give to the charity on a schedule that works for you. The other reason why I really love these is that we all know the markets go up and down throughout the year, right? We know there's times where the markets look kind of expensive. We also know there's times when we know or think that the markets are cheap. So the beauty of the donor advised fund is that you get to put the money in the donor advised fund when you see that it's a good opportunity to give away. So if a stock that you own is hitting an all-time high, you might decide at that moment, let's do it now because I can lock in those gains. And so that's also what makes a donor advised fund really attractive. So again, it comes back to, if you're charitably inclined, this is a great tool. If you're not charitably inclined, that doesn't make sense. This is really for those people who are committed to giving north of 10,000. Whoops. I don't know what happened here. Looks like something tried to open up. All right. Hopefully nothing else pops up on the screen. Okay. Tax savings bottom line. So as you prepare to make the most of your year-end financial moves, remember to talk with your financial advisor or tax professional. The tax professional is the most important part of this. We as the financial planner, we start the conversation, but really your accountant is the one who's going to help formalize the plan, make sure it makes the most sense. They run the numbers, they crunch the numbers. And so that's why it's really important to collaborate on these issues, just to make sure the plan's in place. I will tell you, we are the right people to talk to now. The official 2021 tax year is over. I guess this year it's October 17th. So give your accountants a break. Let them maybe have a week or two off, and they probably won't even have the time off, but at least give them a break. And then we'll start doing year-end planning as we get into November. One of the things that I do want to go into, and you've heard me talk about tax loss harvesting before, when you have years like this year where the markets have gone down, this is a even more critical conversation. So I'm going to walk you through a hypothetical. And I apologize, we got a lot of numbers we're going through, but I just want to walk you through a hypothetical. Every situation is different, but I hope this illustration makes some sense in terms of how we would navigate the tax loss harvesting decision and the impact long-term for you. So the scenario or the hypothetical we're looking at is you have a $5 million portfolio. You have 60% in stock-related investments. You have 40% in fixed-related investments. And so you can see on the bottom, left and right, we have stock investments, 3 million. Those are longer-term focused assets. And on the right-hand side, we have fixed income investments, which are designed to be shorter-term focused investments. You are in a position where, or this hypothetical, that you need 200,000 in annual withdrawals, which 200,000 on 5 million is about a 4% withdrawal rate. So that's what's needed from the portfolio, and that's how we set up this allocation. So this is what we see a lot: buy and hold. We don't recommend the buy and hold strategy, even though you've heard us talk about we're long-term investors. Buy and hold makes sense from an investment strategy, but from a tax loss or a tax management perspective, it's not like buy, hold, and bury your head in the sand. We still need to be mindful of what's happening. And so here's the scenario. So the first column just shows, here's my investment in stocks. They're worth $3 million. Then as we move from left to right, you see there's a 20% decline in the market. We know those are frequent. That happens a lot in the stock market. The stock market by design is volatile. So if you're in a buy and hold methodology, your 3 million lost 20%, which means it lost $600,000. So that's the market correction component. Then the market actually rallies back by the end of the year or whatever period of time we're looking at. The market actually, your account makes 10% over that period of time, which means your 3 million is now worth 3.3 million, right? So you didn't do anything. You get to the end of the year, you realize, okay, I need my 200,000 to live off of for next year. So I'm going to sell 200,000. By selling 200,000, you now have a gain, and you have a $20,000 in realized gains. Your tax liability at 30% is about $6,000. Now, not a big tax liability, but nonetheless, still a $6,000 tax liability. Now we go into what we call really the investment management process that we run through, and really is really something that you should all be looking for, because this is where a good financial advisory company and team can help you in this area. So we're kind of going through the same scenario of the original investment lost 20%, lost 600,000. That's the market correction phase. Now we look at the third column over that says trade, lost, harvest. So at that point, what happens is we come in, trade your account, we sell investments. Now, when you sell your investments, you can't sell one investment and go right back into it at the same day. You can't go back into the exact same investment. You have to go into something that's different. It can be somewhat similar, but it can't be the same. So, and there's code you should follow. This is something you can talk to your accountant about, but we definitely will follow the protocol around how to manage this effectively. So when you go ahead and sell those investments and we repurchase other investments, again, different but similar, we then take this loss. And so you can see the green, we have now a $600,000 loss. Then, like in the other scenario, the market recovers, the correction is over, your account has grown from 3 million to 3.3, which now means you have a 600,000 realized loss, but now you actually have a 900,000 unrealized gain. So the investor sells that 200,000 that they need. You recognize about 54,000 in capital gains. However, there is no tax liability because you have a $600,000 realized loss. And you're also able to take 3,000 as a tax deduction, and that loss will carry forward until you use it up. So this is really what effective tax loss harvesting is. We hate as advisors to have losses. Inevitably, we know they will occur. And so we do our best to manage through these more challenging and volatile times to help the tax situation long term. So quick, because I know we have a lot of guests on this call as we're wrapping up this section on personal taxes. If any of you would like to have, we kind of look at two different options here, kind of our time-tested approach for prospective clients. I need a financial plan. I need a second opinion on what I'm doing. We'll go take you through a discovery and clarity meeting. That's kind of option one. You can sign up for a meeting. If you just want us to do like a complimentary tax review, we have a software company that we work with where we can just upload your tax returns and we can get you a tax report. And really the tax report will kind of help address am I missing any deductions? Is there anything I should do prior to year end to lower my tax liability? So those are kind of the two options. As a client, we're already going through this exercise. We're already uploading the holistic plan. We're getting ready for year-end tax planning. And so a couple quick things as we fully wrap up the personal section, and then we're going to move on to the business planning component. Is if you would like to schedule, you can scan the QR code. We can also just go onto our website at Vance Wealth. And then just so that you know, our next webinar is going to be a little bit different time. I think it's 2 weeks out from today. And we're bringing in a Medicare and Social Security expert. So it's called Medicare and Social Security, What You Need to Know. And Jared Ferguson, Vice President here at Vance Wealth, he's going to be co-hosting that with an expert. So I think it's going to be a great topic. So hopefully you can sign up for that. And then I'll be doing some videos throughout the next, let's say 3 to 4 weeks, just on kind of managing money during during recessions or during, market turmoil. So we'll be addressing some shorter videos on that. So hopefully this was valuable, and please feel free to share this because it's time to start tax planning now. Thank you. Okay, so let's just see here. All right, we still have a decent amount of participants, so let's just dig right into business owner tax planning. So this comes back to a little bit, really our tax philosophy. This admittedly is sometimes I butt heads a little bit with CPAs and tax professionals, and I don't mean to do it. It's mainly because, we as a financial planning, as your financial planners or as a financial planning firm, we are having these conversations about what are your long-term financial goals. We're dealing with like family history, trying to estimate longevity. Like, are you going to be on this planet for the next 30 years? And so when we look at tax planning, we like to look out over this long period of time and say, okay, how do I mitigate taxes over my lifetime? And we also, so that's one of the first places we start. But then the next place is, okay, I want to mitigate taxes over my lifetime. We also recognize that, sometimes it's okay to pay tax. That's kind of the goal. Like that's the goal, is to pay tax. So let me run you through some of our key ideas. So as a business owner, pay yourself a market-based wage. Too often than not, we see people not paying themselves enough in wages. From what I am told, that is a big audit risk. And with the amount of auditors that are going to be increasing at the IRS, get your stuff in line, because you want to make sure you're paying a market-based wage. These are things we can help you with and evaluate and coordinate with your accountant on the best way to do that. But that's number one, do that. That's an easy thing to fix. A lot of people do it because they don't want to pay payroll tax. Well, that's, I think, really short-sighted, because it's really a mistake to do that. It's kind of one of the things that the IRS frowns upon. So let's get that cleaned up. Number two, focus on being profitable. Too often I see too many business owners at year end, they're just trying to expense because they don't want to pay tax. And I run a business. I'm all for saving taxes, but you want to be profitable. That's why you're in business. So if you need to spend money because you need to make an investment in your business, or you want to pay your best people a bonus, and those things are going to save you taxes, do it because it makes sense for the business. Don't just do it to avoid taxes. Remember, paying taxes is the goal. It means you're making money. Again, that's why you have a business. So that's really a real key idea that we have, and hopefully it's profound. But item number three also is, be careful about accelerating deductions using Section 179 and some of the other, depreciation metrics that you can use as a business. I truly believe that if you're in the 24% bracket or lower, something that we reviewed previously, it might be best to pay taxes now. It might be best to, to spread out your depreciation schedule on your assets and not take it all in 1 year. So some of the bonus depreciation, Section 179, some of these things we want to consider. And so those are some of the key ideas. Again, ask your accountant about the specific deductions. That's what they're there for. So we covered this in the first part, but if any of you are just watching the business owner section, on the right-hand side, this just shows the tax rates where they are basically in 2022 and where they are pre the Tax Cuts and Jobs Act of 2017. So again, just want to be mindful that the 24% bracket, the 22% bracket, we think these are temporary gifts for any business owner that's in the income level of 100,000 to 340. We like the idea of spreading out deductions over, over a period of time, and not accelerating deductions using Roth 401ks instead of traditional 401ks when you're in these lower rates. Because again, we think it's a gift. We think these rates might go up. So we don't know, but that's kind of what we're basing a lot of our planning on. So let's get into a couple of the strategies that we look at. So payroll optimization, what does this mean? Well, it first starts with paying yourself a market-based wage, but then it also looks at, okay, what else am I trying to do? Am I trying to fund a retirement account? Well, maybe I need to pay myself a higher wage or lower wage based on that. We all know that, a lot of small businesses, especially, your spouse is involved with the business. And so we like to analyze, a spouse is certainly involved with conversation, directly involved with making the business successful. We want to consider adding spouse to payroll, potentially getting the payroll up to enough of an amount so we can max fund the retirement contributions, which can either put more money into a Roth 401k or actually help defer more taxes. We also love, especially in small businesses, adding children to payroll. If you're in junior high, high school, and even in college, those children that are doing stuff during the summer, maybe just helping out during the week, get them on payroll because there's some real tax advantages to doing so. And obviously there's value to the children, benefits of working at a young age, benefits of understanding the family business. And if you're in the highest tax bracket and you pay your child, let's say $1,000 a month for the work they're doing, you're looking at about $5,000 per child per year in tax savings. So it's worth exploring. Clearly, if your kids are going to be doing any work for the family business, this is an area where you can save some taxes immediately. Retirement plan strategies. So again, we talked about adding spouse to payroll, max funding profit sharing accounts. The one big thing on here is consider Roth 401ks. So we talked about the benefits of Roth IRAs. Roth 401ks are really powerful. There's no income restrictions. So no matter how much earned income you make, there's no limit on income limitations on funding the Roth 401k. And if husband and wife are both working, you can actually fund, if over age 50, you can fund about $52,000 into Roth. So think of the power of that. And I actually have some illustrations here, I think, on the next page. But for your children, if you want to, put them on payroll and you're like, they don't need that money. Well, we recommend maybe put that into a 529 for college expenses, maybe fund a Roth IRA early in life, and the benefits of compounding are quite immense for your children if you add them onto payroll. So this is a chart, a little hard to read, but this basically shows if I took somebody who funded the $52,000 into a Roth 401k, for basically a period of 10 years, that $52,000 over 10 years, which means you're funding $500,000. If the account grows, and there's an if, but long-term investing in stocks and longer-term assets, an 8% return, future value of that in 20 years is 1.6 million. Approximately in 25 years, 2.3 million, and in 30 years, 3.5 million. So you can see the benefits of making some of these decisions and the future growth, and that's all designed to be tax-free because they're in Roth 401k accounts. So again, this is something that we think can save a lot of money over time, and something should be considered for your plan. So how I'm laying this out, like when we take our clients through some of these tax strategies, again, in coordination with their accountant, we're going to go from left to right here on the screen, is we want to do an annual personal tax return review. This is something we are kind of internally calling like our due diligence process. We're going to review your personal return, your business return. We upload it to a software so we can get some personal insight of what's happening, coordinating with the accountant, and just make sure if we're doing planning, that a lot of the planning ideas are actually getting implemented, because what's a good plan if it doesn't get implemented? And then some of the ways that we help is implementation of the Augusta Rule strategy through what we call our Simplify Day, or our monthly planning day. Allows you to potentially rent your house to your corporation up to 14 days tax-free. In many cases, this can save, let's say, $10,000 to $25,000 a year in tax. Payroll optimization, depending on how many kids you have, hire your spouse and children. We're looking at maybe $5,000 to $20,000 per year in potential tax savings. And then retirement plan design, like how do you utilize 401ks, Roth 401ks, profit sharing plans, defined benefit plans, things like that. We see that, clients can fund a lot. Some of these plans, you can even put a few $100,000 in there. And in those cases, we're looking at deferring, at the low end, maybe $7,500 in tax, and at the high end, even $100,000. So these are all like effective planning strategies that we just have to evaluate. It's hard to give a lot of examples here. I can kind of ballpark the numbers because we've been doing this long enough. But the key is to get in and do the work, is analyze your current situation. You're different than everyone else. Even though you might be a business owner, you are different than your neighbor. And so it's really important to tailor and customize this solution for you. And then also have an advocate like our firm, where we're actually helping to make sure these things not only are planned for, but actually got executed on and done in an effective manner. The last thing that we're going to end on here, and it looks like the personal section was about 40 minutes, and business is going pretty quick because we've summarized it, but there's a little bit of, I don't want to say it's a little bit of a word of caution, but we did a webinar back in June of this year and talked about the reality that, we thought we were in a recession. And that was before we officially kind of moved into recession. Now, I will admit that there are still signs that we're not in the full-blown recession yet, even though if I pulled out an economics textbook and read the definition of a recession, it essentially is 2 negative quarters of GDP growth. And we had 2 negative quarters in the first quarter and the second quarter. So we are officially in the recession, but the reality is the employment market is still okay. It's deteriorating. But the reality is it looks like we're when we called that we're in a recession, maybe we were forward looking a little bit. We're on the way to a recession. The thing that we don't know is this going to be what we call like a soft landing or hard landing, right? Is this going to be kind of a shallow recession, or is it going to be a deep recession? And we don't have a crystal ball. We think it's going to be a little bit more shallow. But what we are recognizing, it's going to hit different industries at different times, which is why I think this recession is going to be a little unique, right? You're seeing in some industries where the recession began long ago, and then you're seeing industries like the energy market, there is no recession, like they're booming. And then you're seeing, real estate has held up really well until like the last 2 months, and that's been slowing, right? So this recession is an interesting one. Every industry is going to kind of have its fits and starts, and depending on how things play out based on the industry that they're in. So we do think this is probably going to last for a little bit of time. And that's one of the reasons why I'm going to be doing and hosting a bunch of just shorter videos on like managing money during a recession, because I think that's a lot of people's fears. What should I do? Should I not invest? And I think the short answer to that is no, you should always be investing, especially with long-term money. But this is what I really wanted to talk about in this slide. So this is around the tax planning. And then I have the last one is just a reminder from a protection perspective. So if your business is expected to be weaker in 2023 than in 2022. So for next year, if you can already forecast that we're seeing a slowdown, that revenue is going to be weaker next year. So again, meaning that income is expected to be lower next year, then our recommendation, and this is not blanket wide, you still need to factor in what your current tax brackets are to maximize this decision. But here are some strategies that could make sense. Number one, accelerate deductions into 2022, right? So if you already know income is going to be lower next year, maybe you make sure all those deductions are taken now, right? So maybe you spend a little bit extra in December based on things that you're going to need for next year to get the deduction. That'll help with cash flow in terms of reducing some of the tax liability. Number two, you could also look at delaying income, right? So many people are, invoice their clients, maybe December, you actually invoice in January, right? So you delay that if possible. Every business is a little bit different. Number three, liquidity. Liquidity is going to be key. And we all know that. You got to start hoarding cash, and hoarding is a little bit of a dangerous word, but you want to make sure you're maintaining cash for liquidity purposes. You want to go talk to your banks right now, increase your line of credit. 2 months of expenses is, I say ideal, it actually is like minimum. Like you've got to have 2 months of expenses in the bank or on a credit line that you can tap at any time, because you don't know what the disruption might be on your business. I do like targeting about 6 months of expenses. So if you have the ability between what you would have accessible in cash, what you'd have accessible in cash equivalents, what you'd have accessible in a credit line for the business, maybe even a home equity line, adding all those up, if you can get to around 6 months, that puts you in a really good position to weather a tough economic environment. And I don't know how deep it's going to be or how shallow it's going to be, but we definitely want to be prepared, because sometimes when we don't know what to expect, adds a lot more stress, and the uncertainty can cause us to make maybe business decisions in the short term that aren't great for the long term. But by having cash, it frees us up to make better, more informed decisions. And so these are some things to be having conversations with your accountant, mind you, in November, planning for this year, about what are the things they should do, or what are the things you should do to help put you in a better position. Then the fourth one on here, this is a little bit out of the blue, but it's manage your vendor relationships and accounts receivable. So when we go into a slow economic environment, the biggest risk for a business, perceived risk that you might not even be aware of, is that what if your vendors can't pay you? What if you make something, deliver the service, and they don't pay you? So I really recommend tightening up your vendor relationships, making sure whoever's doing, your accounts receivable, that's collecting money from your vendors, they have a working conversation. They understand what's going on with the vendor. Tighten up your collection terms. down to 30 days or less if you can. Maybe get stuff paid on credit cards immediately, even if you have to pay credit card transaction costs. Because one of the risks that you have is that you could be providing a service to somebody. If they go out of business, depending on how bankruptcy works, you might not get paid. And that could be a massively disruptive to your business. So pay a lot tighter attention to those issues. And especially if you have like accounts receivables that have been aging, if you have that's happening, you might want to talk to a business attorney and better understand what your exposure is on accounts receivable that has been aged. And so one of the advice that I've gotten from a colleague is that if you have a client who has receivables, or you have an invoice that's old, I think it's older than, I believe it's 30 days, but older than 30 days, and you have a new fresh one that's younger than 30 days, and they make a payment and they want to apply it to the older, that you're actually best suited to apply it to the newer one. I think there's some rules in bankruptcy law that protect you more in paying current invoices versus paying old or aged invoices. And so I'm no expert in that. If you're worried about that because some of your vendor relationships, I would highly recommend, again, talk to a business attorney, talk to a bankruptcy attorney. You just want to tighten things up. When we go into recessionary environments, things that you don't think can happen might. And so we want to be prepared for that, because you want to protect your business, you want to protect yourself, you want to protect your family. And so again, tighten those things up, especially if you have long collection cycles where it takes 60 days, 90 days, because those are things that could put you at risk as a business owner. Last thing on here we already talked about, but if you are not a client of Vance Wealth and you would like us to do a more thorough review, we kind of have two options here. Is really our time-tested approach, where we'll help you update your financial plan, get a second opinion on your current plan, which involves more in-depth planning discussion around financial planning, tax planning, and investments. We'll do a discovery and clarity meeting to see if we're a good fit and if we can help you. The other option is kind of a more simple path, is to do a complimentary holistic plan review, which will use our tax planning software to run a report that we can provide to you. And it can kind of help identify, am I missing out on any deductions? Is there anything I should do prior to year end to lower my tax liability? Just kind of helps with that. So with all that, we are all wrapped up. So if you want to book an appointment, you can do so at vancewealth.com, or you can scan the QR code. And as a reminder, our next webinar is Medicare and Social Security, what you need to know. This will be hosted by Jared Ferguson, as well as we have a guest speaker. And note the date. This will be 2 weeks out, not a month from today. This will be our advanced perspective webinar for the month of October. I will be back in November to discuss kind of the election. By then the election date will be passed. Hopefully the election will already have been decided and all the races, and we'll know what happened with the House and the Senate. And I will provide kind of an update on what we think that means for the economy on a go-forward basis. And so I hope this was valuable. I know we went through a lot of tax-ish planning, a lot of code, just things that can get heavily into the weeds. But thank you for being here tonight, and have a great evening. Thank you very much.